Welcome to another EliteTutoring.ca video. This is Julie Carreri, and today I'm going to teach you all about the weighted average cost of capital, or WACC for short. We'll usually want to find the weighted average cost of capital when we want to evaluate the value of a project or the value of an entire company. We would need to take all the future cash flows of that project or company and discount them to today's date, times 0. If you have experience in calculating net present value, then you would have heard the terms cost of capital, discount rate, required rate of return, or opportunity cost of capital. These are all essentially the same thing. The weighted average cost of capital is all of these things. The WACC gives us the overall return that the company needs to make on their existing assets in order to maintain the value of its stock. It's also the required rate of return the company needs to get on any new investments that have a similar risk level to the company. That is why the WACC makes an appropriate discount rate. So here's the formula, and I'm going to explain it to you, but I'm just going to read it out loud right now. The weighted average cost of capital equals the value of equity over the value of firm times the cost of equity. When we say equity, we mean common stock equity, plus the value of preferred equity over the value of the firm times the cost of preferred equity, plus the value of debt over the value of the firm times the after-tax cost of debt. To understand a little bit more about the WACC, we need to first look at the company's capital structure. It makes sense that the more expensive the company's capital is, which is positively related with how risky the company is, the greater the cost of capital, aka required rate of return, we need in the project's investments we take on. So if we end up finding that the WACC of a company is 12%, this would mean that investments or projects the company takes on that have a similar risk level would need to return at least 12% in order for them to maintain or increase the company's or shareholders' net worth. We would also use the WACC of 12% in a valuation model for the overall company, where we are looking at discounting the forecasted earnings. WACC becomes the R in our calculations. So if we end up finding the WACC of a company as 12%, this would mean that investments or projects the company takes on that have a similar risk level would need to return at least 12% in order for them to maintain or increase the company or shareholders' net worth. We would also use the WACC of 12% in a valuation model for the overall company, where we are looking at discounting the forecasted earnings. WACC would become the R in our calculations. For WACC, we need two parts. The breakdown in percentage of the company's capital structure to give us our weightings. These are the initial parts here. The E over V is the weighting in equity. The P over V is the weighting in preferred equity. And the D over V is the weighting in debt. A company's capital structure is often made up of equity and debt, but could be just one or the other. This typically includes some mix of common share equity, preferred share equity, and different forms of debt, often corporate bonds. In order for the WACC to be valuable for us from a finance perspective, we want to use market values for everything, not book values. Those are used more for accounting purposes. To get the market value of common share equity, we take the number of shares outstanding and multiply it by the current price of the stock. This is also called the market capitalization of the stock. If we are not given a current price for the stock, we could use a model to calculate it based on common share dividends, return on equity, and growth. However, with a public company, you would just look at the current price the stock is trading at. Similarly, to get the market value of preferred shared equity, we take the number of preferred shares outstanding and multiply by the current price of a preferred share. To get the market value of debt, we take the market price of a bond and multiply by the number of bonds outstanding. We would ignore short-term debt and only look at long-term debt of the company. We would then get the weightings for each of these types of capital. The total value of the company equals the value of equity plus the value of preferred plus the value of debt. To get the weightings for equity, we would take the value of equity over the total value, the E over the V. For the weighting in preferred, we would take the value of the preferred over the value of the whole firm. And for the weighting in debt, we would take the value of debt over the total value of the firm. Together, these weightings will sum up to 1, which we will use a fake company as our example in these calculations. Suppose our company had the following information given as you see here. We need to get the market values for each of these. It's very simple. For common share equity, we take 1,500,000 shares times the market price of $22 to get $33 million market value, also known as market cap. So this is 33 million. This is what the market is telling us the net worth of the company is. Often we will want to use our own analysis of forecasted revenues and earnings to say what we think the net worth of the company or the value to the owners of the company is and compare the two. If we find that the net value of the company is greater than the current market cap, we're saying that the market is not efficient and the company is undervalued, which would make it a great buy for an investor. If you find that the net value is the same as the market cap, then the market is being efficient and the company is fairly valued. This could still be a good buy as long as the risk level and return is a good fit for the investor's profile. The market value for preferred share equity is $20,000 times $16 to give us a $320,000 preferred share equity value. So obviously they have a lot less weighting in preferred shares. Finally, the market value for the debt is $10,000 times 850, giving us $8.5 million for a market value of our debt. We sum these three values to get the total value of the firm because we know that V equals our equity plus our preferred equity plus our debt. If we sum these together, we get $41,820,000. Now it is very simple to get the weightings. Equity weighting is 33 million over the 41,820,000, which is 78.91%. Okay? Preferred weighting is 0.765% just by taking that 320,000 over the whole firm value, and the debt weighting is 20.33%. Summing these gives us 100% or 1. So it is accurate. Note that if we had different types of debt or different classes of preferred shares, we would just treat those as additional types of capital and get their market value and their cost of capital. We wouldn't group them all together just because there's two kinds of debt. We wouldn't just group all the bonds together and multiply them out because they have those different costs of capital associated with them, which means they have different yields, depending on the length of the bonds and the risk level of the bonds. So you would just keep them all separated and add them all together and do the weightings the same. Now we need the cost for each of these types of capital. We have multiple ways of calculating the cost of equity. The most common way used by CEOs is to use the capital asset pricing model, but a dividend discount model is fairly common as well. In this lesson, I will be using the CAPM to get the cost of equity. In order to calculate the cost of equity using the CAPM, we need to estimate beta and market risk premium if they are not given directly in the question. If there is no beta available for the company and we don't have the data to do a proper regression calculation, which would be typical, then we can use either the industry beta, which can often be found online, or the beta of a similar company in the industry that has a similar risk level in operations. If there is a difference in the capital structure of the comparable company or the average industry capital structure, we would want to get an unlevered beta and adjust it for our company's capital structure. This is a little bit more advanced and will be covered here. For the risk-free rate, we typically use the 3-month T-bill rate, which is readily available. For the market return, we would use the return on a market portfolio, either the S&P 500 or TSX index. An American company would use the S&P 500. For our example, we'll say that the risk-free rate is 0.5%. Okay, and that the market return is 4.5%. This gives us a market risk premium of 4%, which is this portion in here. Also, let's assume that the beta for our company is 1.3, so slightly riskier than the market. Our cost of equity would therefore be 0.5% plus 1.3 times the market risk premium of 4%, which gives us 5.52%. Note that by using the CAPM, we have some drawbacks that we would want to mention in our analysis. We are using the past to predict future performance, which is not always correct, and our results are sensitive to estimates in the market risk premium and beta. To get the cost of preferred stock, we want the current yield on the preferred stock. We have the current price of the preferred stock. Many times we won't be given the dollar amount of the dividend. In our example, we are told that there is a $25 par 6% per preferred share. This means that the dividend is 6% of $25 or $1.50. Okay, so you take the par value times the percentage that's stated, okay, in the name of the preferred stock. Recall that the current market price is $16, so the cost of the preferred capital is $1.50 over 16, which gives us 9.375%. Okay? After-tax cost of debt. First of all, we want to note that it's the after-tax cost of debt that we're interested in. This is because our cash flows to debt holders, the interest payments, are tax deductible. We didn't do after-tax for the equity portions since dividends, the cash flows to our shareholders, are not tax deductible. To get after-tax anything, we take 1 minus the tax rate. We want marginal tax rate, not average tax rate. If the marginal tax rate is not directly given, there are a lot of tax calculators available online where you can plug in the earnings for the company and get a marginal tax rate. Marginal tax rate is the tax rate paid on the last dollar of income earned. The cost of debt is usually easy to find. It's the yield to maturity on long-term corporate bonds for the company. If it's not given, you can use a financial calculator or formula to get the yield to maturity using the current price of the bond, the length of the bond, coupon and face value amounts, with R as unknown. Or you could use the yield to maturity on bonds with similar bond ratings, meaning similar risk level. Okay? If you are using a financial calculator, make sure that everything is semi-annual. So the coupon would be our semi-annual coupon. The T would be our number of years to maturity times 2. And we'd remember that the R that we get from our calculator is actually only for half of the year, so we need to multiply by 2 to get the yield to maturity. Okay? A lot of times we are just going to be looking at the yield to maturity on bonds with similar bond ratings, as I mentioned, if we're not given a YTM in our actual case. For our example, let's suppose that the marginal tax rate is 30%, okay, and the yield to maturity is given as 4%. Our after-tax cost of debt would simply be 1 minus the 0.3 tax rate times 4%, which gives us 2.8%. Finally, we put this all together to get a weighted average cost of capital. We take the weighting in equity times the cost of equity plus the weighting in preferred times the cost of preferred plus the weighting in debt times the after-tax cost of debt. I have shown you in the formula what it looks like with just plugging in the weightings here. Okay, and now I use percentage for the weightings, but when I go to plug in the costs, I use the decimals. You have to choose to only do one of them as percentage so that your final answer will be in percentage form for your WACC. Calculating this out, I get a WACC of 4.9968, or rounding 5%. Thank you for watching the video on WACC. Email me, julie@elitetutoring.ca, if you would like a custom video created or want to join my mailing list to get updates when elitetutoring.ca will be live with more tutoring and video content. Check out my other videos on YouTube, username Julie Carreri, and subscribe to my channel so you can watch any new posted videos right away. Thank you.